now. Anthony, you with us?
Yes, sir.
All right, just making sure you knew where that unmute button was. We're good. Ryan, Tom, and Anthony here with you guys. All right, so today is all about the three most important mortgage programs we think you guys need to know about to be successful in 2025. We think 2025 is going to be very similar to 2024. We think properties are going to even start sitting a little bit longer. We think buyers are going to have more inventory, and it's not going to be as much as a seller's market as we've seen the last 5 years. So if you've only been focusing on those listings, you want to get more buyers. We really feel like this is the year to do it. And these programs are the ones to focus on. Tom's going to start us off. He's going to focus on PHFA, mostly first time home buyers. Then we're going to kick it to Anthony, probably the most important program, the 2-1 buy down of how you can keep this market going, even with rates being a little bit higher. And this is good for listings and this is good for buyers. And then I'm going to finish up with the DSCR program, our most unique program we've ever had that we just got opened up. And that's for investors only, where you don't have any income regulations. You don't need income calculation whatsoever. It's all based off of credit score and the appraisal. We'll get into that. So let's get going. If you guys have any questions, throw it in the chat. I think we have a question and answer as well. I've never used that before. We'll give it a try. I don't even know how that works. But Thomas,
Hey,
let's go.
so thank you. Thank you for everybody joining us here today. I do think this webinar that we're going to talk to you about is going to be beneficial to getting buyers as well as having a successful 2025. So I just want to get started off here with the PHFA product. It has been around for a long time now, since even before I started originating. They had some nuances come in. We'll go over that as well in the last 5 years. But overall, I just want to kind of give you what it looks like for a first-time home buyer going through the PHFA program. And I want to go over in the beginning before we kind of go into the different product. PHFA, that's not an actual loan. PHFA is an investor. That is Pennsylvania Housing Finance Agency. So they're technically a bank that would be buying this loan. So people do get confused. They think when I say PHFA, that's FHA. That's not true. PHFA is the investor. And through the investor PHFA, you're still able to get all of your normal mortgage products, conventional FHA, VA, as well as USDA. Really, today, our main focus is going to be the first-time homebuyer conventional product, or the KHL, Keystone Home Loan product, which is the main conventional product that you can get through the PHFA, or Pennsylvania Housing Finance Agency. So with that, Brian, you're sharing that screen right now. This is just kind of giving.
Tom. I hope so.
I see it, so I think we're good. This is just giving you a little bit of comparisons between just a regular conventional mortgage on the right and then our PHFA conventional on the left. So the main difference is right there in the third bullet point. We highlighted it for you. If somebody can qualify for this loan through PHFA, their interest rate can almost be 1% lower. And that is the big kicker when we're looking to qualify somebody. I know I could speak for Ryan and Anthony, and definitely for myself, that when somebody calls us to get pre-approved, this is the first loan product or thing that we're trying to get them approved for, because we're always trying to get the buyers the best deal possible. And as you can see, I mean, those APRs speak for themselves as well as the rates. That is the better product for the buyer. Little caveats that do come into play with it. We need to have a little bit of a higher credit score, 660 as opposed to the 640. Even so, down at those levels, it still is very difficult to get a conventional loan approved. So they would have to have other compensating factors. So we are still looking for a little bit higher than those credit scores to get approved for the conventional. They must be a first-time home buyer to get within this product. They must meet the income limits as well. And PHFA has strict income limits. The thing about their income limits, it's not about just the person that is getting the loan. it's about every single person that's going to be living in the house. So if they're married, that we are going to find out that they're married as well as there's another income in that house. You have to get tax returns for the last 3 years for everybody in that house. So that is the way that they are going to determine that you are under or over that income limit. That income limit, we're hoping it goes up here a little bit in 2025, but it's currently still sitting at 102,600. That is the household income limit for 1 to 2 people when trying to get this loan. And again, this is just for the conventional through PHFA on the left-hand side, 5.875. I mean, have you guys, Brian, Anthony, have you guys seen anything close to that? I mean, that 6.75 is where everything was today.
Yeah, I mean, no, Tom, you're exactly right. If you can qualify, right, if you're a first-time home buyer, the income limit's the toughest one, especially when you start getting 2 people. It starts getting tough to be under the income limit. But like Tom said, it's our number one maneuver when we first pre-approve a first-time home buyer. We are trying to get them in this program because they're getting the same exact mortgage as they would in the secondary market, but the rate is cheaper. So why not? There is, I mean, if you're going to say a pest inspection is not a reason to get the mortgage because that's one thing you have to get, I think that's a little crazy. I would get a pest inspection for almost a whole 1% reduction in rate.
Yeah, I mean, pest inspection on average, I would say it's about $100 right now. Not going to break the buyer's bank, but we could save them $100 a month just off the rate. So, 1 month we get our savings back. So, this is the first product. We're always looking to go to this product if the buyer does have the funds as well to close. Now, there are a couple other options that we could roll into for this, and I'm going to bring up a page here in a second to show you that. That is the K-Fit product, and we've been talking about this K-Fit product since it rolled out in March of 2020. It's been a great product for us. I don't know the percentages on how many loans we closed at West Penn with this product last year, but I'm assuming it's near 10%. So that's a decent amount of loans for this one individual product. And the reason why it's so prevalent and we have so many is because buyers right now, they are hurting for money. Everybody's hurting for money. Things cost more. They don't have the money in the bank to buy it. So typically on a conventional transaction, I'm just going to say on average 12 to 20,000 you need for closing costs. But a lot of buyers come to us with only 4 to 5,000 in funds in their bank. So that's when we have to look into the secondary product called the K-Fit product. I'm going to share my screen here, show you some facts that go along with this K-Fit product as well. You guys see that?
Yep, we can see it.
Perfect. So it is a second mortgage. It's going to be attached to that first. It will not have a monthly payment on it though, because it's built into the first mortgage's interest rate. So the K-Fit stands for Keystone Forgivable in 10. So it is a forgivable second mortgage, and it's forgiven at 10% every year. So what does that mean? So if we sell our home after 6 years, that's 60% of it. So we would still owe 40% back at closing to pay off that loan. If you were to stay in there for the whole 10 years, that loan would be completely forgiven, and we would no longer need to pay it back if you were to refinance or sell it. There would be no loan to pay off. It would be completely forgiven. This is very beneficial for a lot of the home buyers that we're talking about that need the additional funds. You're allowed to get 5% of the sales price for the second mortgage. So just on an easy number, we'll say $200,000 sales price. You're allowed to get $10,000 on a second mortgage to help pay for down payment or help pay for your closing cost on that loan. That's a huge deal. We're getting a lot of people into homes using this product. And this product itself, I know we just talked about the conventional product through PHFA, but this K-Fit product can be combined with any loan type, not just conventional. I've seen it done with a VA loan. I've never done it with a USDA loan, but it can be done. and I've done it with an FHA loan as well. They're all great deals. They could be combined with seller's assistance as well to really get the buyer in cheap on the home. They will have to either come with 1% or $1,000 minimum to the transaction. So that is going to be one of our requirements. The buyer does need to bring something into these deals when they're getting these done. So that's something we look through underwriting, though. Nothing you need to worry about. We're just letting you guys know these products so you could go out there and tell people when you're going to parties, you see them at a church event or wherever, hey, we got a great product for you, regardless of your financial situation. So this is a good way to try to help you get some more buyers. Again, this one does need the 660 credit score as well. And then we also going to look on the qualifications that they don't have assets and they're not just trying to use the state for their funds as well. I think overall, I'm sorry, go ahead.
I was just going to say, Tom, I think that, guys, it's a great program. We live in Pennsylvania. PHFA, like Tom said, it's not a mortgage type. They're a state agency, a banker, an investor. They're a Pennsylvania Housing Finance Agency. We just happen to live in a state that has a good one, and they have good programs. Most of their programs, right? They're a government agency. They're there to help folks get in the homes. If you got a buyer that's got $1 million in the bank and is putting 20% down, that's not what this program is for. It's to help Pennsylvanians get in the homes, mostly first time home buyers. So they have great low rates if buyers don't need the closing cost assistance. If they don't have all the funds to close, like Tom said, most first time home buyers don't, they offer the 5% closing cost assistance, but that's allowed to be added on top of any normal seller assistance you're going to get. So the buyer can get seller assistance and closing cost assistance. That allows them to get into the home with least out of pocket that they're going to get. They're not going to get a better deal in the state of Pennsylvania. And the rates, like sometimes PHFA's rates are comparable to the secondary market. Sometimes they aren't. Sometimes they're way out of whack because they aren't. They have different rates. They base different things. Right now, the PHFA rates are very, very competitive. Every first time home buyer, their number one step in what we all do is to try to get them pre-approved PHFA. If they don't qualify because they make too much money, then we move on to the different program. But that should be your first option is, and again, that's what we do. You send them to us, you get them pre-approved, we get them into this program. On your guys' side of things, all you have to worry about, the buyer has to take a counseling class that's online because they're a first time home buyer, got to learn a little bit about to be what it's like to be a homeowner. It's a very basic class. You need a pest inspection. Other than that, guys, is there anything on the real estate side that we need to warn the agents on a PHFA deal?
Just maybe if it is a house with a well that you see like out in the country a little bit, we will need a bacteriological test as well. But that home buyer should be getting a bacteriological test if they have a well anyway.
And on the flip side, PHFA does have to approve these loans. So that is the number, I would say the only drawback. Just understand, we get everything from the buyer. Our underwriters get it to, we believe it's clear to close. We send it to PHFA for approval. There's times PHFA approves loans in 2 days. There were times earlier in 2024, they were taking 3 weeks by themselves. In those cases, we needed a 60-day close. So we just ask that if you guys know they're pre-approved for this loan program, we know we're working with them, we're getting them in the first-time home buyer program, just double check with us when you put the offer in, like, hey, what's the timeline here? Because again, we're here to meet closing dates. We don't want to get you into a transaction where 2 weeks into it, we're having trouble meeting that closing date. We don't want that to happen. We don't like that. We don't want those phone calls. We want to get the closing date on the sales contract. So that's the only other thing. Anyone else to add? Anything else?
No, I kind of just want to quickly just touch on the rates of these programs to kind of get you more. I know we showed the one page just to get you more of an understanding why we're really pushing this. So on the Keystone Home Loan product, the normal product without the second mortgage, you're looking at about a 5.5 on a government loan, FHA or VA, and a 5.875 on conventional, like we said. With the K-Fit, you're looking at about a 6.25 on a government type loan and a 6.5 on a conventional. So, yes, I said that right. 6.5 on a conventional with a K-Fit. So that is still lower than a normal conventional loan that we were showing you that rate of. So this is a great product for that first-time home buyer. You could even still get the extra funds and still have a lower rate than just doing a normal loan. It really behooves a buyer to go to, one bank and not actually shop for this type of product. I feel like every buyer should be shopping for this product. Regardless, they need to talk to somebody to see if they qualify because they do live in the state of PA. They want to buy in the state of PA. They need to take the benefits that the state is giving them. So they really should be getting a second look or at least getting pre-approved with us to make sure that they could get if they could get this product.
That's it. And that's for first time home buyers. And how PHFA works, you have to be a lender that gets signed up and set up with them. So is West Penn Financial the only lender that works with PHFA? Absolutely not. Have we been working with them since the 80s or 90s, whenever the heck we got signed up with them? Yes, we have a very good relationship with PHFA. We know what they require and we close loans all the time. And that's why it's just why get the same mortgage when you can qualify for a lower rate? So that's why we're pushing PHFA and we're pushing all your buyers through that. You don't even realize it, but every first time home buyer is getting pre-approved for that program. And then we're just letting you know if they qualify. We're running all the first time home buyers through it automatically. All right. So that's first time home buyers. This is not for just first time home buyers. This is for all buyers. This is Anthony's specialty. He was first on the block 2 years ago, heck, maybe 3 years ago, started talking about this program. It is the number one way you can save money in the short term if you're a buyer. It's the number one way you can sell a house that's sitting there for a couple months or weeks, whatever it may be. Anthony, take it away. 2-1 buy down.
Good afternoon, everybody. So, great job, Tom. Yeah, PHFA is a great program. So, definitely let your clients know some of these options that West Penn has. But one of the programs, I'm going to need everybody to put your buyer hat on. Okay. Not the real estate hat, but act as a buyer in the thought process of what a buyer is thinking in today's market. One of the biggest struggles for a buyer in this market is affordability. Affording that monthly payment based on higher costs for homes, increase in values, increase in purchase prices, increase in rates. We're always trying to understand the buyer's need as far as the financial end to make this home purchase more affordable for them. We're actually going to dive into some options here so you have a clearer picture of how presenting to a buyer when it comes to that monthly payment and overall cost could definitely sway their mindset on what they're going to buy. I've always said buyers aren't buying houses because of the price. They're buying it because of the payment. If it's not affordable, doesn't matter what the price is, they're not buying. So we have to make sure that price is affordable, that they can be able to buy. So we're just going to start off with if they are buying a property today, using an estimate of $250,000 purchase price. Rye, you see my screen?
Good. You're good.
All right. So
Sorry, I was
250,000.
muted. I was giving you the floor, Anth. I see your screen. Get with it.
Gotcha. So $250,000 purchase price is what I'm using as an estimate today. Minimum 5% down is the estimate, and 7% interest rate based on today's pricing. The monthly payment's $1,980 a month. Now, this is if they don't do anything, they don't ask for anything, they just go in and ask for or give the seller what they're asking for. This is what it's going to look like. Now, if I switch this up a little bit, let's say either you're listing the property, the house has been sitting for a little longer, and you want to do a price reduction, and or the buyer wants to go in with a lower offer on that property because they want to get a deal. The numbers are going to change, but not as much as somebody would think. And to create that momentum of a move, let's say the purchase price drops to 240 from 250. That's 10,000. Seems to be the going drop of price. Let's drop to 10,000, create some momentum. Based on that purchase price, the loan amount would go to 228, same interest rate based on today. The payment's only dropping $66 a month. So that's going from $1,980 a month to $1,914 a month. Not a huge move in monthly payment to make somebody jump out of their seat and say, hey, I'm going to pay this price. I'm going to buy this house today. We got to get some momentum going, especially in a higher rate environment, and providing those options with lower payments and more affordability will help do that. So one of those programs is a 2-1 buy down. If you don't know what a 2-1 buy down is, it's a temporary buy down for the first 2 years. The first year, it's going to be 2% lower. The second year, it's going to be 1% lower. I'm going to show you what those numbers look like in comparison to doing nothing and or dropping the price 10,000. So looking at that third option there, keeping it at 250. Loan amount's going to be 237.5, but you're going to notice this interest rate right here. That interest rate is going to change to 5% because it's 2% lower the first year. What's that going to do to the monthly payment? That's going to drop that monthly payment pretty significantly for that first year. So it's going down to $1,675 for the first 12 months. That's $305 a month in savings that client's going to save for the first year. Now, if we do this the second year, it's going to be 1% lower. So now that's going to change that monthly payment to $156 a month is going to be that monthly savings. That rate's going to be 6%. Because remember, 2% lower the first year, 1% lower the second year. And then what happens after that second year? It's going back to the original rate of 7% that they originally would have gotten today if they did nothing. But it is saving them that much money on a monthly basis over a 2-year time frame. So I'm a fan of this program versus a price reduction, and it's actually going to save. Let me move over here. It's actually going to make you more money as an agent because how do I do that? Because if you actually drop the price 10,000, your compensation is going to be based on that lower purchase price. The cost to do this is only $5,535 for a buyer to get the 2-1 buy down. So you're still making, what is that, $4,500 more on the purchase price? So your compensation is going to be based on the higher amount, the 250 instead of 240. Okay, so this is a great option for buyers to take advantage of as far as lowering their monthly payments. Now, if we're trying to stretch this out, okay, most people would say, okay, well, $66, they're going to save that after that 2 years. Okay, great. But most buyers, as we know, the rates don't seem like they're coming down to the fives, anytime soon this year, but in that instance, when they do, the first thing buyers are going to do is refinance. Okay. But this is a fixed rate. So worst case scenario, if the rates don't come down, they're going to be at the original payment of the 1980. Okay. But looking at a 2-year, span of what they're saving, they're actually saving, 305.14 for the first year. And then they're saving 156.16, 24 months. Saving $11,000, guys, over 2 years. If you just drop the price by 10 grand, they're only saving $1,589. So showing a client options of what they're going to save now monthly, and then also what they're saving over 24 months, they're saving more monthly and over 2 years than they're saving if you drop the price 10 grand. Okay. So it's showing momentum to buy, a reason to buy. $305 a month is a car payment. $156, hey, that could be half the car payment, but it's definitely a valid option in this market in a higher rate environment. And that's where we got to change things up a little bit. Let buyers know some of these programs, the PHFA down payment assistance, the 2-1 buy down. Clients want to buy. They just need to know how to buy. And we're your resource, which is going to show them how they do that. So Any questions?
Now, I feel like even if this is good, if you're a listing agent, you could go to the other buyer's agent that brought somebody through your house, say, hey, we may be able to offer you some seller's assist. Have you talked to your buyer about a 2-1 buy down? It could be worked on either side. This is something great that we could offer to them. And Anthony has this sheet right here to show them all the comparisons. So this is a great product.
Guys, it's all about saving the money now. We know price reduction is it's just second nature to you guys. House isn't selling, we're going to reduce the price. We're going to reduce the price. We're trying to get out of status quo. All three of us hate status quo. And frankly, what Anthony just showed you was keeping money in your pocket. If you're going to reduce that by $10,000, which is a pretty normal price reduction, if you ask me, compared to all the seller's doing is prepaying the interest for the buyer for that time frame. So it's cheaper for the seller. It makes you more money, and it makes that buyer's payment so much affordable for the next 2 years. We understand it's only a 2-year buy down, but the rate goes back to where it is today. So in that year 3, if rates have gone up, they're still winning. And if rates have gone down, well, then maybe it's time to look to see if it's time to refinance. But it's not an arm where we don't know where this rate is going. We know exactly where it's going to. And instead of dropping the price 10,000, and sure, you'll save that money for all 30 years. I don't know how many buyers stay in their mortgage for 30 years. And frankly, I want my savings today. I don't want to save $66 a month in 27 years. I don't know what that's doing for me. I don't know if I'm going to be on this earth in 27 years, frankly. So the way I look at it is, here's what it is today. Here's what it is tomorrow. Here's what it is year 3. But if that payment's $300 less for that whole first year, you might have a good chance of getting that house sold. And that's why we're pushing this. And all it is seller assistance used in a different way. You can't use the seller assistance to drop your closing costs and get the rate buy down. The seller assistance is used by the lender to buy down the rate, not to lower closing costs. Cool. Great job, boys. Great job.
See what you got.
All right. So now I got the most unique program. They left me for the crazy program. So we've been working, all three of us have been, if you know Rick Schrum, bald little guy, we've been working on them to get some unique programs. We've been all over. We finally came to us with something very, very exciting. We get it. We know that Pittsburgh is a hotbed for investors right now. The city's on every list, most affordable. I mean, I just saw a thing today. We're top 10 cities of no natural disasters. That's pretty big these days. Affordability, no natural disasters, pretty decent weather, minus this winter. Good place to live. We have a ton of investors out of state, even foreign investors. We get a lot of investors, you guys being self-employed, sometimes on paper, what we need for mortgage purposes doesn't allow you to qualify for a normal investment loan for the secondary market. So we have the loan called a DSCR now, which is a debt service release loan. That just means that, let me see if I can get my slides to move. That just means we don't need any normal requirements for the mortgage. This is not a secondary market loan. We do not run AUS. We do not talk to Fannie Mae or Freddie Mac. They have nothing to do with this program. It is strictly a portfolio investor program that we send off to our specific investor. What are the highlights? Yes, you can close with an LLC. How many times have we gotten this question over the years? I want to buy the home. I wanted to have it in an LLC. We could never do that. We can now do it with this program. No W-2s, no pay stubs, no tax returns, nothing required for income on this loan. We only need a 640 credit score and 6 months of reserves for the investor. Now, again, remember, investment properties only. We're not looking for primary residences. We're not looking for unique homes. We're not looking for farms. This is going to be your standard investor that buys a lot of homes or was starting to buy a lot of homes and wants to do this, pretty much as a living. That's what we're looking for. So, even for yourself, Schedule C, don't have any income on your Schedule C on paper. We get how that works. Maybe you can now be an investor as long as you have the 640 credit score and the appraisal comes in with the comparable rent schedule, at least 1-to-1 with the mortgage payment. That's the major qualification for this loan program. We need that. We get a normal appraisal. For an investment appraisal, there's a comparable rent schedule. That comparable rent schedule has to say the rent is at least equal to the mortgage payment. 20% down, normal on any investment loan. Remember, no income is needed. I keep getting that question. Are you sure? Are you sure? Yes, no income requirements are needed. This is how it gets calculated. You just do. The gross income is the principal, interest, taxes, insurance, homeowners and associated, whatever may be in that mortgage payment. It has to be equal to the comparable rent schedule. We can do 1-to-4 units. We can go up to 3.5 million. We do need the 20% down, or if you have anyone that needs a refi, 75 LTV on the refi. Another big thing, non-warrantable condos. We know all about them in our area. There's a ton of condos that have become non-warrantable. This program allows them. So if you have investors that want to purchase any of those non-warrantable, maybe a listing you have, send them our way. We can now get it closed. Again, investment properties only. You can use gift funds. We don't care on the limit of property someone owns, and you can do short-term rentals. So there's a lot of positivity to this program, a lot of uniqueness to it. The non-warrantable condos, I think, are going to be huge. We have turned down so many loans in the last couple of years, me, Tom, and Anthony, just ourselves, because the complex is non-warrantable. And if you're not familiar with non-warrantable condos, maybe that's a seminar in February for us, because that could be a whole category by ourselves. But a lot of the complexes, since that condo collapse in Miami, Fannie Mae and Freddie Mac have tightened up their guidelines, which have made a lot of condos non-warrantable, which makes them hard to get financing behind. So we now have an avenue for those. Sometimes we have to put a little bit more down. You're going to need 25% down for those programs there. The big one, too, closing in an entity. So LLC, S Corp, partnership, we can do them all. We can do them all. Just it does get a little hairy when there's multiple people involved. If there's anyone else involved in the entity, we do need them to get credit pulled. The investor does not want this buyer covering for a bad credit score partner. They want to make sure all partners are good. They want to make sure all partners have good credit scores. They also will have to be on the loan application. They got to sign the loan application and be on it. So there's a couple different parts of it. If you have investors that have multiple folks of their partnership, let us know. So investment only. We think Pittsburgh is huge for investment. We think we don't want to miss out on that. We think there's a ton of buyers out there for you guys to sell on that particular program that can't qualify on paper. So frankly, We had Tom cover first-time home buyers. Every first-time home buyer should get qualified through PHFA to see if they can get one of their programs, either the lower interest rate or close with $1,000 out of pocket. Anthony showed a 2-1 buy now. If you can get seller assistance and your buyer doesn't necessarily need help with closing costs, or you have the listing not selling, it is unbelievable how affordable it makes that home in the short term for the next 2 years. And then the DSCR program for investors. We think these three loan programs, anyone can do a conventional loan with 20% down, frankly. Okay. You're going to have that buyer shopping around like crazy. We're more concerned about the unique buyers you have that we need to get loans closed because we get it. 1, 2, or 3 more sales throughout a year can be the difference for everyone. And we want to make sure we're that lender for you. So, guys, do you have anything to add? Because that's all I got right now.
Hey, Ryan, I just wanted to touch on that DSCR program. I mean, great job. That's a great program. I mean, if you guys, everybody knows an investor or somebody that wants to be an investor, and most of those people are clients we've already worked with. You know, that we've helped them buy a property in the last 12 to 24 months, 5, 10 years. The unfortunate part is, like Ryan was mentioning, it normally we have to qualify clients based on their current debt ratio, carrying their current monthly mortgage payments, as well as any debts against their income versus the new payment. On this DSCR program, we're not going to have to do that. It's just specifically, like Ryan said, based on the actual sole property they are buying. So their debt ratio and their income is not even in play. So it's self-sufficient. So this could be a great opportunity to maybe reach out to some old clients that maybe couldn't get a loan. You know I certainly am. And, let them know that we have this program available now where we can just debt service coverage the current property that they are buying based on rent schedules so that they can either become an investor or start on one or two. It's a great program. I think it's going to be great for this year. I know everybody knows at PHFA most of the time, but these programs are going to be pretty hot this year, I think, to help affordability and help everybody, help clients buy homes. How you guys like my new glasses, by the way? Looking pretty
You're trying
smooth.
them out enough. I mean, geez, oh man. Yeah, thanks again. We know it's lunchtime. There's no good time to do any of these. We know everyone's busy. We had a ton of requests to record. That's why we recorded because it's the middle of the day. But we really do appreciate everyone taking, even if it's 2 minutes to watch AM Chatter in the mornings, taking time out. We want to educate the best we can. And we thank you for being on today. And I am going to stop the recording now.